VT, excited to talk to you about this. Um, Before I talk to VT, the investor, I want to talk to VT, the entrepreneur first. About 7, 8 years back, you moved from what was Sequoia to set up A91. Talk to us a little bit about that transition. How did you think about entrepreneurship at that point in time in your journey?
No, it's an exciting question, and it has been 8 years, and it would not have been possible without my two other partners, Gautam and Abhay, who were also partners at Sequoia, and whom I have had the luxury of working for many years now, both of them. I think the stimulus for doing something on your own, I think it is hard for an investor, at least at our stage, not to feel that at some point of time in your life, because you're meeting founders day in and day out. All shapes, all forms, all with varying degrees of success. But one thing you're always very sure when you meet founders is they're bloody excited about what they're doing, right? They're very passionate. They are enjoying themselves, irrespective of size of outcome, size of business. I think those are all secondary questions. So when you see founders in action, it's hard to not want to be a founder yourself, right? It's almost like a temptation you have to resist. And I had spent 11 years with founders from 2007 to 18 after I joined Sequoia in 2007. And I'm sure the same true for Abhay and for Gautam. But I think the stimulus for why start A91, I think what you realize, and after being in a very good, high quality, fantastic investment firm for 11 years, is that I think it's about how you think about your journey ahead and your role ahead. And what you often realize is when you're an investor in a high quality firm, you're making investments, right? You are making investments, you're finding investments, you're responsible for them. But what you realize is finally for the portfolio to make returns, the portfolio has to be constructed. So one is if you really have to step back and say, am I investing or am I building a portfolio? I think first was portfolio. Second is, what is a strategy that you can pursue? Because we had spent 11 years in India, seen the investing business, and then I'm sure many of you, and some of you may have been in big corporates, you'll have a view, right, on the market, on where the opportunity is and what you want to do. But the reality is when you're working in a global firm, you have your strategy, but the strategy has to bend its will to what the global priorities are, right? Versus saying, hey, look, if de novo you had the opportunity, what would you do? And what would be the way in which you... So the ability to articulate and execute your own investment strategy. I think that was a very strong impetus, because after 11 years, we felt we had learned enough. We had had our successes, we had had our more than our fair share of failures. And therefore, we felt that we had a chance to execute our strategy, execute it to build a portfolio. And finally, look, I think it is hard to do this if you are... Because one of the things, any journey from a career professional to an entrepreneur is, it's a reset, right? And to enable the reset, I think you have to think about time horizons very differently. I think as a successful professional, you can think of careers in 5 years, maybe 10 years, if you have the luxury, and the firms do that, and some firms do that. But I think the luxury of being an entrepreneur is you can think in 20 years and 25 years. But then, because you need to see that much, because, I often see professionals and my own friends who'll come and say, I'm thinking of leaving and starting. But behind their head, they're also asking the question saying, okay, there is obviously an opportunity cost of today, because I'm doing this very successful career, there'll be an opportunity cost, and then there's a probability of success. So when will it meet, right? And I'll always say, look, if you do DCF, you can never be an entrepreneur, because your cost of capital is so high. Therefore, by definition, there's no way. There is no way. Even 10 years, 10 years later also, you'll say, what? I might have been more successful in a firm. So I think you need a very long horizon. And to me, that was the opportunity. I turned 40 in 2018. And that also gives you a bit of a clock to ask these questions. So I would say these are 2-3 things, and then it all came together. And very grateful that not just me and 2 other partners who had worked together saw it the same way, and therefore we could embark on the journey together.
Lovely. If I may just maybe underscore a couple of things you said. One of the things you said was you saw entrepreneurs enjoying themselves. One of the things I often say is you can't work to your potential, you can only play to your potential. So very often entrepreneurship is about really playing in an area that you feel really passionate about. And the second is, I think also in terms of people's journeys, I find that when you come to a certain point, let's say around 40, 45, 50, people move to what is often known as a self-authoring mode, where you want to sort of back your conviction, back your beliefs, and in a way do something which gives you at least agency to back your beliefs. So thank you for sharing, VT. Just picking up on what you said, now that you've been on this journey for about 7+ years, what are some of the elements of entrepreneurship that you underappreciated at the time you took the plunge? Now, with the wisdom of hindsight, what are the 2-3 things that have surprised you?
I think, and some of it may not. When you say underappreciated, is it assumed to have a negative tinge or a positive tinge?
Both ways. Both ways.
Both ways. Because some of it is a positive surprise, and some of it, of course, is the things that you underestimated, right? I think one thing about being an entrepreneur is the amount of time that you suddenly have to only focus on the firm objectives versus personal objectives. And what I mean by that is, and there's nothing wrong. I think when you're in a company and when you're working in a professional environment, right, there is success of the firm or the company that you're working in, which is outside, and there is success inside. Right, because as a professional, you want to get promoted, you want to get a higher bonus, you want to have a bigger team. If you're a marketing person, you may want a bigger budget, whatever it is, right? So there is always 2 axes of success. Successful professionals know that very early, which is the firm must succeed and then you must succeed inside. Firm succeeds outside and you succeed inside. Both are important. What you don't realize is how much time goes in both. And depending upon the nature of the firm, the nature of the culture in the organization, the amount of time can be very, very different on these 2 elements. I think one of the powerful things about being an entrepreneur is that you have 100% only focused on winning outside. So therefore, Mike Moritz, Sir Mike Moritz, who was a partner at Sequoia and head of the firm when I was there in 2007 up to 11, he used to say the competition is outside the building, right? And that is truly true, and you feel it that way, I think, when you're an entrepreneur. So I think this is something I underestimated. You always kind of say, you know what, you're balancing it or you're doing a good job, but I think you underestimate it. So that's amount of time. I think the second thing this I definitely underestimated is how much time you think about people and culture, right? These things are so abstract, right? Definitely very abstract when you're sitting in the classroom, even abstract in the context of firms that you work with, but you just realize how important, culture is. And when people say, culture eats everything else for lunch or dinner or whatever it is true actually, and you have to therefore very carefully think about people, additions, complementarity of people, ability to work together. The amount of time you spend on organization is way more than what I would have thought. That is something I would have definitely underestimated. I think, those are probably 2 things at least that stand out for me.
Yeah, absolutely. And I think on the culture front, what I've noticed very often in my conversations with people is, you take a decision, but there are level 2, level 3 implications of a decision, which often, if you're not intentional about, can shape the culture.
No, absolutely, right? See, because it's so much, right? For example, one of the things my partner, and this is one of my partners, and we go back a long way, his way of giving feedback in life is samajhdar ko ishara hi kafi hai, right? That's his philosophy. And he's probably done that for 25 years. So you can't wake him up and say, today, you have to be super blunt, direct, and firm. The thing is, if you're going to build an organization where that is the culture, then you need samajhdar people who will get it.
Yes.
And therefore, when you're thinking about hiring, you have to make sure, does this person like to read the room? Because there are very successful people who don't care for reading the room. Because the implicit assumption is, feedback will come to me when it comes to me. So I think absolutely.
Moving along, VT, I'm curious about how companies evolve. And we all know, at every stage, there's a probability of success or failure, and there's a graveyard of companies that don't make it. Um, and I guess if I look at the profile of the audience here and the companies that IMA Ventures invests in, these are early stage companies where probably the 0 to 1 and the 1 to 10 is taken care of. But I'm curious about any maybe systemic themes that you notice in sort of in the failure modes of, let's say, the 10 to 100 or 100 to 1000. Again, painting with a broad brush here, but in your journey as an investor for a decade and a half plus, what are some of the themes you've seen where breakdown happens?
Of course, this is a more harsher review of what I've seen. So I think you're absolutely right. I think instinct-wise, the reasons for failure in the 10 to 100 or maybe 0 to 1 are very different from 100 to 1000. Okay, so I think the reasons are different, and therefore, let me talk about 0 to 1 first and what I have seen as reasons why things have failed. I think three things I can think of. One, especially if you're a product company, which is usually the case in most people, actually a product or a service aimed at a client. I think one reason for failure of 0 to 1 is that you have substituted capital for product market fit. And what I mean by that is, Jain Baba, as we used to call him, he always used to say in marketing, Professor A.K. Jain, that demand is need backed by purchasing power, right? So the key is you want demand. You don't want needs, because there are many needs in the world, right? So the question is it really demand? Now, when somebody doesn't have any money, the demand has to come organically. So then this proof of success is you have a product and it's sold and somebody's paying for it. That's clean demand, right? But very often, naturally, to minimize risk, to enable the market, to lubricate the start, you raise capital to do it, right? But when you're using capital as a stimulus for demand, you still have to be very careful in knowledge that you've used capital for demand, right? So what happens if the capital goes in a different direction? Sometimes capital is used for subsidizing the product. Sometimes capital is used for subsidizing the margin. And that is a risk, because if that risk problem is something that is not fixed in 0 to 1, irrespective of the amount of capital you have raised, it will fail. Because capital cannot find product market fit. Only consumer insight and real need backed by demand can solve for product market fit. So this is the classic graveyard 0 to 1, happens often. I think that's one. Second reason why sometimes it fails is because when you raise capital, especially for many of you, this is IMA Ventures, so I'm assuming most people are raising money to build a business. There is an aspiration of how big it needs to be for it to feel justified for you or justified for the investor, right? But sometimes the size of your dream and the size of what it takes for your company to build may be bigger than the market, right? So what do you do in that case, right? An old-fashioned entrepreneur would have grown in line with market, as you would have called it, right? But sometimes some of you may not have the luxury or time or patience. You may not have, your investor may not have. So that's the second reason, because then you're trying to be bigger, but actually the market is not that big because of where you, and nothing to do with you, that's where the market is, right? I think that's the second. And the third is ego. See, at 0 to 1, the fundamental reality for the founder and for the investor is to be very responsive and nimble. You can't force the customer to have a want or a need. You can't force a market. So it's also quickly about realizing that, hey, you know what, like this is not working. Should I try this? Should I try that? And that nimbleness, both you and the investor. Because I remember many years ago in one of our companies, I was an investor in a beverage company. The company had launched a product. Summer had happened. It is not a great launch. And the founder came to us and said, okay, so, by the way, this has happened and I'm planning to launch this new product, a completely different product. First was an energy drink and this was a juice company. And he said, are you okay? I said, of course I'm okay. He said, why? I said, you're ex-beverages private limited. So you're a beverages company. If this is not working, you have to try something else, right? And I think that's important. I think that nimbleness and that flexibility and humility to learn and kind of is important. Because sometimes people get very carried away, very stubborn, mule-headed. All of them are positive and negative qualities, right? Resilience doesn't mean, fighting till the end, Smart retreats.
It's not bullheadedness.
Yeah, it's not bullheadedness. The Battle of Dunkirk. Right? The strategic retreats are also a part of long-term success.
And any headlines on 10 to 100? These are the 0 to 1.
Yeah. This is always the more exciting part. 10 to 100 is a little bit more boring. I think, see, the challenge in 10 to 100 is that, actually, this is the real challenge. Yeah? I'll give you the difference between 1 to 100 and 100 to this. See, 1 to 10 or 1 to 100 is like getting into IMA. Existential. You say, oh my God, I need to find a way to get in. This will make my life. 10 to 100 is what do you make IMA of? What do you do there? And what do you not do there from a long-term perspective? And the reason I say that, I give that analogy, is because that is exactly the problem of a founder who's already gotten to that first 0 to 1. Business is there, dhanda chal raha hai, paise ban rahe. So what happens? So I think there, the reasons things don't go to plan is because one is how do you keep the flame alive? Now you don't have any existential risk. Company will not shut down. Factory is working. 1,000 people are employed. Now everything is opportunity lost. It's not negative. It is positive. Is if you didn't do this, this is what will happen. So the mindset required for a person who is fighting an existential battle to survive, and the mindset of a person who says, there's no existential battle, but there's an opportunity cost of life. What do I do with it? That is the big mindset shift. And because then it enables you to do very different things. The founders who succeed, the 100 to 1,000 are therefore founders who are still listening to the market. Because market is changing, consumer is changing. Are you doing it? Right? The founder is a founder who continues to learn. And how can you learn? You can only learn by meeting people, surrounding yourself with experts, hearing diverse views, pushing yourself to learn. There's no need to learn, but you have to push yourself to learn. So this is the part of your book, which is how do you learn after 30? Right? Because till then you had to earn money, you had a job. But what happens after that? That is, I think, the journey of most companies, this 100 to 1,000 is that journey. And the people, the founders who succeed are those who still have that, you can loosely call it fire. But I think the nature of the fire is very different. And founders have to realize this and make the switch.
Fascinating. And you've sort of started talking about the next question I wanted to ask you, which is as the companies scale, founders need to scale and leadership teams need to scale. And you've touched upon a couple of themes already, but I'm curious about what you've seen among the various founders you've worked with and your observations of the ecosystem. What is it about some of these founders who scale in line with the company or ahead of the company very often? What are some of the things you've observed?
No, I think the openness to continuously learn. I think they're building circles of experts, circles of mentors, and two are very different. Experts is saying, okay, I have a problem in recruiting. I don't know how to recruit well. What do I do better? Circle of mentors is, hey, let me try to get other people who have been in this journey. Can I get them on the board? Can I get them on the advisor? Can I go and spend time and ask him, what is it that has to be done? So these are two very, very different circles. So I'm able to get different expert, high quality advice. I'm able to get different mentorship experiences and willingness to therefore change based on that.
And just if I may double click on that, is there a difference in the kinds of people that fall in these buckets?
Yes, absolutely.
How do you distinguish
the two? Mentors, for example, could be founders who've seen this journey before. Right? I am trying to build a 100 to 1,000 crore company. Let me go and talk to other founders who have built 100 to 1,000 crore company.
Who've seen that movie.
Let me not go to a CEO of a 10,000 crore company because it's fancy and there may be something interesting to learn, but it's a different learning. It's a learning, but it's a different insight, right? And I think that's the one. And the reason why it's important is, see, the goal of a small company is to become a big company. We badmouth big companies, we make fun of big companies. But let's be very clear, the goal of every small company is to become a big relevant company. So the key is to therefore find out what has worked and be willing to make the changes required for it, because by definition, that will be required and you'll have to see how to do it.
One was mentors and experts.
Yeah.
You were sort of...
I think experts and mentors, so I think of them as two. Third actually is... It's, I think, the most interesting, and I think successful founders do that, is you have to find a way of renewing your energy. Because the nature of the energy is different, as I said. There's no existential burning platform, right? So how do you motivate yourself? How do you, what? So you have to go a little bit more inside yourself and find those things that you need to do to get your energy back. And it can be completely different. Like without taking names, I know of two founders, completely different ways they get energy. One gets energy by going on a 36-hour fast every 15 days. One gets energy by going to Marina Sands in Singapore every month and gambling. Completely fine. But how do you do that? Because you need that, right? How do you get your energy back? Because to do all this and be open-minded to change and think of all these things, you also have to enjoy it. And then they find their own ways. And they both use that to re-energize themselves and come back. And I think it also gives them some chance to reflect whatever they're doing.
I think that brings me to the next theme, VT, intensity and longevity. We often hear people say it's a marathon, but at the same time, the short term feels like a sprint. So whether it's in your case or the entrepreneurs you've worked with, how have you seen people manage this tension?
Yeah. So I think actually there's no tension, and I'll tell you what I mean by that. I think it'll sound strange coming from a capitalist, which is what venture investors are and early investors are. But the reality is that it's no founder, truly long term, over a very long period of time, successful founders, you can never build on the back of financial metrics, valuation metrics, etc. I think successful founders have the ability to really look at these metrics as markers along the road, but they don't confuse the numbering on the map with the map itself. Right? And the reason I say that is that the most successful founders are therefore founders who are truly enjoying the game. And what is the game? The game is usually, in a consumer product founder, it is that insight for the next product. It is the nudge to the customer to embrace a superior product. There are only two kinds of, if you're a consumer company focused on a product, there are only two kinds of products. Either you're explaining the customer why he needs the product, or explain to the customer why he needs to improve the product. But that is the excitement. And it's the problem solving of how do I do it? Have I succeeded? Have I failed? And then a tick mark against it. Right? Many years ago, we had, I hope I'm quoting Rahul Dravid correctly. We had Rahul Dravid in a place like this, and we were asking questions, right? And somebody asked him the question, saying, okay, when you go into a match, how do you decide or motivate yourself, saying, this match I'm going to try to score a century or a 50? And this is Dravid, of course, with all his humility. I don't think he said, I'm scoring a 50 or a 100. He said, actually, you know what? He knew, I cannot believe it, Deepak, he knew the number of balls he had faced. Every ball, how many were dot balls as a percentage of his total dot balls, life balls that he's played. How many he's defended, how many he's scored, how many he got out, and how he got out. And he gave us a statistic, which is probably still true, that Roger Federer was the greatest tennis sportsman, because he got some 54% of all points ever played in his life, right? Not the number of games. So I think, like all things, musicians, artists, sportsmen, the entrepreneur game is very similar. I think the question they're asking is, I have 100 things, am I getting it 60-40 right? And the excitement is in getting the 60 right. And for a consumer company, it may be getting a product right, getting a marketing right, getting a pitch right, and getting a distribution right. And that is how I think the reason, therefore, successful founders last long term is because they really enjoy this game. And that's all the game they want to play.
It's fascinating. Resilience, that's another thing that comes up very often. What have you, and we've been through a quake with COVID, which was which sort of tested all of us in different ways. What have you seen about resilient founders? Are there one or two, let's say, character traits that stand out for you in terms of how they encounter these shocks or deal with these shocks?
No, I think two things. One is ability to face the truth in a very calm and a collected fashion, right? Which is so they're not delusional. They're not drinking the Kool-Aid. So if something happens, I think this is what has happened. But at the same time, I would say finding the inner strength to motivate others, because there will be all kinds of people in any organization, right? And I think one is individual resilience, which is easier in the context of sport or art. But in the context of a business, it's not just enough if you are individually resilient, right? It's also about how do you build energy and enthusiasm for the team that is working with you, and kind of tell them that, look, there will be some light at the end of the corner. And look, and during COVID, we've had all kinds of companies. So companies that had enough cash, companies that did not have enough cash, companies where, the lockdown started, for those of you who still remember, literally in the most important season of them. And I think it was all about, I think the way to demonstrate resilience was just finding that ability to look at the truth, deal with it, and also and also remember that while they may be individually resilient, they also had to rally people to a cause, not forgetting the others, because that was important. That was important.
I'm looking at the clock, 5 minutes to go. Maybe one last question, and then I'd love to throw it open to the audience for one or two questions. As an investor, any, let's say, top 2-3 themes you've seen in the entrepreneurs that have a healthy way of, I won't say managing investors, healthy way of engaging with investors?
Yeah, no, that's the right word. I think that's the right word. See, I think no, that's an important question, given that spend a minute before we invite some other questions. See, I think what are the boundary conditions, right, at the end of which a founder has decided to raise capital from an investor, any investor, individual, institution, incubation lab, whatever be the nature of the place you're raising money from. I think the three, four boundary conditions that you have automatically signed up for if you have raised capital from an investor. I think the first is you have decided to get a partner in your business. I think that's the first. And then we'll talk about what it means in terms of expectations. Second is you've broadly got a partner who's aligned with you from a medium long-term perspective. I think that's the second, because that's the good news. The reason why you got the partner is because you not only got money, you also got somebody who will now think along with you in terms of how this business should be built, right? You are expecting, obviously, it's never going to be life is not a straight ship. So you are expecting a person who will be with you in the ups and downs of the business you're building. Because sure, you're a smart entrepreneur, you know that there are going to be ups and downs. It's not going to be a straight ship. And therefore you want somebody, and you pick this partner saying, hey, this partner will up and down of life, I will be able to manage it. The fourth is, it's a partner with an exit date. Right? You have invited the partner, but you also know at some time, 5, 8, 10 years, 12 years, sometime, this partner also has to leave. Right? That's the 4 boundary conditions at which you have got an investor. And therefore, everything to engage successfully and have a good relationship is to do with these boundary conditions. Right? You have a partner, number one expectation that you will have of your any partner, life partner, is transparency. Transparency means bad news first. Nobody cares about good news. First is any upfront bad news, because that's a clean, open relationship. Second is you want a partner, therefore you want to be listened to. You don't want, no investor wants a founder to do what they are saying. Because if the investor wants a founder to do what they are saying, the investor should be doing the business, right? Not the founder. So all smart investors, good investors, know that you're backing the founder and the founder instinct. But they want you to listen to them, so that just think of them as you have one more opportunity to stress test how you're thinking and improve the quality of your idea and execution. So do you have that openness and collaboration? That's the first is bad news first. Second is open and collaborative process where you listen. You're not just hearing, you're listening, you're reacting, and then you're using it to improve. And that's the second. And I think third is to recognize that, look, there is a exit time frame, which every investor has. And that decision was taken. A lot of times founders will say, Chabi, you have to start thinking about exit. And I'm saying, you didn't think about exit now. You thought about exit the day you raised money. Right? The day you raised money from another entity, that's the day in which you have already thought about exit. That's therefore an obligation. And therefore, by definition, you have to have a realistic assessment of where will this business be. Does it have the chance to be a standalone business? Does it have a chance to be a public company? Or should it have a longer stint as a private company? Or should it find a home? And these are all objective conversations. And these are not emotional conversations. They're objective conversations to be had because, on day zero, sometime long back, You said, I want to get another investor. I think that's the 4 things. So I think a good engagement with investors is just being easy about it. I think realizing these things, acknowledging where people are coming from. At least that's my view.
Lovely. Thank you, VT. We have literally a minute or two on the clock. I'm told by the organizers
Not even a
that
minute?
not
Okay.
even 42 seconds. Any 1 or 2 questions from the audience? Maybe we'll pick 1 or 2. Sure, the lady there.
Thank you so much for sharing the insight of 0 to 1. I just also wanted to understand the journey from 1 to 0 as well. When to know that we have to close down this and again start from 0 to 1. Of course, we have the various tools and like market validation and things like that. But when is the time to realize that, okay, it's time to close this business and put our energy in another business? Because we don't know when the tunnel will end at, and we did some right.
That's a great question.
VT,
I think
VT, quick one. Do you want to take a
Yeah,
couple of
let's
questions
start the
and
question
then...
as well. Yes, answer both. Okay. Yeah, that's it. Or
And the lady there, she had the... So maybe just that one and then you can choose.
I want to ask you what your current biggest challenge is as an investor.
okay, all 3 different questions. So let me take one by one. I think the great question. At what point do you say, hey, this much and no more, right? I think it's very much a founder's call. So it's very hard for investors to help investors to make the decision. You don't want to be in a position with investors making the decision, which usually means money is run out and there's no more money, right? That's the worst way to figure out what to do, right? I think it's the founders. As a founder, I think you're constantly making the trade-off between the amount of capital which is there in the bank and how much time it is giving you. And that's one of the conversations you'll keep hearing is runway, right? How much runway does my business have, right? And typically when you're raising money for the first time or the second time, you're typically saying, can I have a runway of at least 18 to 24 months, right? So therefore 2 years is your start to finish experiment, right? And therefore sometime within month 3, month 6, you have to have a sense of what are your markers. And if you're not hitting those markers, should you change tack? Because one of the things you must do is if you're not hitting the markers in month 3 and month 6, you may pause. Stop doing those things and at least allow yourself to give more runway so that you can decide what to do, right? And I think that is why the sense of cash flow, the sense of how much money you have in the bank, and the sense of at the time when you raise the money for those 2 years, did you have clear markers on where you wanted to be in 3 months and 6 months is very, very important. Don't do it after the money has come in the bank. It's better to do it before you go out and raise money. Because then you have a sense of what to look for and what not to do. That's the answer. I think to your question, sir, I think on founders, I think at least, and I have rarely seen a founder who goes around, oh, I have SK here. I can see SK here. Hi, SK. I'm sure SK will agree with me. It is very hard for a founder to say, I will build this market cap valuation or IRR. I've rarely seen founders do that. I think founders are excited about the business they're in. And they recognize that valuation, IRR, and returns are a function, are an outcome. And the outcome is influenced by many things. It is influenced by the market. It is influenced by, crisis along the way, anything that can happen along the way. It is influenced by multiples, how those industry or how that company is perceived by the market at that point of time, right? But we all know that, Mr. Market is, almost always emotional, unstable, and illogical, right? Therefore, by very definition, it is very hard to say, given this, how can you ever say I will build for valuation or IRR or multiple? Therefore, at least in my mind, at least as an investor, when we're looking for founders who are actually excited about building their business. Now, the value of that business, as always, eye of the beholder, function of the market, recent growth, expected, future, but then it's expected future, right? We don't know the future. So it's very hard. And I think if you tie yourself out to these metrics, there is a real higher risk of failure. Because, there may be many years, there may be a few years where the right answer may be to just hold the business and do nothing and not even grow it. And that's the right thing to do for the business. It would not be the right thing to do according to, any valuation score or Excel sheet, but that may be the right thing to do. And third, very hard question. What is the biggest? I think the most challenging thing for an investor at our stage is being on top of what are the various things that are changing and what are the things that are not changing. I think that is the biggest battle, because a market context change, right? And then you have to ask yourself how it feeds into your investment strategy, how it feeds into your valuation thinking, and how it feeds into your investment philosophy. For example, I'll give you a simple example. Now, if your business, a big part of the profitability of the business is driven by tariff structure of India and other countries, how does that data point feed into your investment strategy? Right? Some people, you could have taken a view that I will not invest in a business where that a stroke of the pen, many years ago, that's what Professor Sebastian Morris from IMA used to say. The stroke of the pen benefits, right? If it goes away, what happens? So, as an investor, do you want to take the risk, not take the risk? Or do you say the world has changed, this is how it's going to be, therefore I'll take the risk? So the reality is market context change. And then suddenly you're asking the question, should I reflect it in my investment philosophy or should I just ignore it? Same with opportunity, because things are changing all the time. Like, for example, if you think about a consumer product company, in the last just 12 years of my investing, we have seen modern trade and then e-commerce and quick commerce. So 3 channels of disruption have happened. And therefore, as a consumer product company, you're always investor, you're thinking, what does it mean for my companies? What does it mean for, what does it mean for brands? And how should I think about growth? So I think market context and geopolitical context, or lack of economic context, provide enough excitement for us to be constantly challenged.
Lovely.
Thank you.
VT, on that note, thank you so much for this wonderful conversation.